How many millionaires do you think are there in the world? You won't believe this number, but there are almost 47 million millionaires worldwide. And guess what? Almost 20 million of them are here in the United States. Let me give you one more shocking statistics. Every year, around 700,000 people become millionaires just in the United States alone. It seems like becoming a millionaire isn't as difficult as many of us are led to believe. But, as we all know, it's almost impossible to become one if you do not learn how to invest. Most people are interested in the stock market, but the problem that many people face is how to find good stocks. How do you know if it's a good stock to buy or not? People usually base their decision on the news. If the stock is rising and it gets a lot of attention, it must be a good investment, and vice versa, of course. Unfortunately, that is the worst way to invest. By the time it's out there in the news, you're probably late. So here in this video, you will learn how to find great stocks. How do you find stocks that will rise in value over time? If you stick around, by the end of this video, you will learn how to analyze stocks like a professional investor. Apple has a valuation of $2 trillion, and its stock price is traded at around $120 at the time of this script. But what if I told you that just in August of this year, Apple's stock price was $500? Does that mean that the company was already valued at $10 trillion and it lost 80% of its value in the last few months? In fact, Apple's stock price in June 2014 was $645. Does that mean that the company was way more valuable back then? Not really. That's why looking at the stock price is not investing. Oh yeah, that's Warren Buffett's quote. If it already seems too confusing, don't worry, because that's why I'm here, to simplify everything for you and turn you into a professional investor in under 10 minutes. Because the YouTube algorithm told me that my audience are some of the smartest subscribers on the entire platform and they learn 10 times faster than anyone else. So, I'm counting on you. Don't let me down. If you take a look at the companies that are traded in the stock market, they have a price tag. But because no one can afford that, they're broken down into many stocks. The key question is, does this company really worth $768 billion? The answer is no. You see, there's a big difference between price and value. The stock price jumps up and down every single day. Even slightly negative news that could be fake can drive the price down. However, not the value, because the value is what the company is really worth. For example, in July 2018, Facebook's earnings weren't as high as some of the investors expected, so the stock price fell from $217 to $176. That's a 20% decline. The company lost $120 billion of market cap in a single day. Does that mean that the company became 20% smaller overnight? Of course no. That's why the stock price jumped back to its pre-decline level and is 30% higher now. So if you want to make a good investment, you have to find out the real value of the company and then compare it to the price that it's traded in the market. If it's undervalued, it's a good investment. If it's overvalued, it's a bad investment. It's as simple as that. In 2002, Buffett came across a company called PetroChina. After analyzing its financial statements, it was clear that this company worth at least $100 billion. But when he looked at its market cap, the company was traded at just $30 billion. And based on the political climate, it was clear that oil prices would rise. He knew that it was a golden opportunity, so he invested almost $500 million into this company. And guess what happened? The company didn't just reach a $100 billion valuation, but it skyrocketed to $275 billion. Buffett sold his stake and earned $3.6 billion from this deal. So the question is, how do you find the real value of a company? One of the most popular methods is the PE ratio, or price to earnings ratio. It basically means the amount of money investors are willing to pay for every dollar that this company earns. It's a simple tool to measure if the stock is overvalued or undervalued. Let's say hypothetically, Apple earned $2,000 this year and has a total number of 1,000 shares. Dividing Apple's earnings on the total number of shares gives us earnings per share, or EPS in short. This means Apple has earned $2 for every share. To find the PE ratio, you have to take the price of the share, let's assume it's 50, and divide it on EPS. In this example, investors are paying $25 for every dollar that Apple earns. In other words, it would take the company 25 years to pay you back. A good PE ratio is considered something around 15. Anything higher than that could mean that the stock price is probably overvalued. Tesla's PE ratio is, for example, 970. Does that mean that Tesla is overvalued? Maybe. Or maybe not. When finding a PE ratio of a certain company, we take into account earnings per share for the last 12 months. But when you invest in a certain company, past earnings don't matter. What matters is how much the company is going to earn in the future, which is why there is something called forward PE ratio. Of course, you can't know for sure how much the company is going to earn in the future. So the number that is used is the average of what experts usually predict. If we go back to Tesla, despite it having astronomical PE ratio, its forward PE ratio is closer to the Earth at 123, which means you will have to wait 949 years to earn your money back if you invest in Tesla based on its past 12-month earnings. But experts are calming us down by saying that, don't worry, it's not that long. Tesla is going to be much more profitable. So it's just 123 years, which is why most investors consider Tesla an overvalued stock. But we all know that Elon Musk is an alien and he's going to prove everyone wrong, as he does all the time. The price to earnings ratio isn't the most accurate method to value a company, but it's the simplest way to have a broad idea of how the company is performing. The company might come up with a revolutionary product and beat all expert predictions. So to make a wiser prediction, you have to consider other analysis as well, such as price to book ratio. It basically means how much the company is going to earn if it sold all of its assets and paid off its debts. Let's return back to Tesla. Tesla has gigafactories, thousands of charging stations, offices, patents, and a lot of other assets. Let's say they all amount to $100 million. But it also has a lot of debt, let's say $70 million. If we subtract its debts from its assets, we'll get a book value of $30 million. So if Tesla has 10 million stocks, its book value per share is going to be $3. To find out how much you will be paying for each dollar, you have to divide the stock price, which is let's say $15, by the book value of shares. In plain English, you will be paying $5 for each dollar of assets that Tesla has. A good price to book ratio is considered something around 1. But sometimes it's really difficult to put a price on something like an algorithm that Instagram is running on or Snapchat filters. But financial analysis is just one part of the story. Startups, for example, usually have a lot of debts and not many assets, and might struggle with cash flow, but could end up becoming widely successful. So never rely on financial analysis as the sole predictor of companies' success. There are many other indicators that we have covered in previous videos, which links I will leave in the description. Nevertheless, financial analysis can give us a better image of how the company is performing. One of the metrics that investors use to value companies is discounted cash flow. It can help us to understand where the market is overall headed to. Without getting into a lot of details, I will explain what discounted cash flow is, how is that related to what the Fed said, and will there be another crash? Interest rates aren't just important because they make borrowing money cheap or expensive today, but also because they influence the value of future cash flow, which is what investors are concerned about the most. You don't care about how much the company is earning today or how much it has been earning in the past. What matters at the end of the day is how much the company is going to earn in the future. Based on that, you will decide whether you should invest in this company or not. Stocks always compete with other types of investments such as bonds, cash, fixed deposits, whatever. Let's say you have $1,000 in your pocket. Is it better to invest in the stock market, bond market, or just keep it in your wallet? Obviously, investing is way better. Let's say interest rates are just 5%. If you invest in government bonds, your $1,000 will worth $1,005 next year. So it's important to look at the time value of money. The sooner you have the cash on your hands, the more it's worth, because the sooner you will be able to invest it. $1 today is worth more than $1 tomorrow. So if the company is going to earn $1 billion 5 years from now, it is not going to be $1 billion, because $1 billion 5 years from now worth less than $1 billion worth today, because you could invest it and get 5% at least every year. So it's not enough to look at the company's future cash flow. Oh, this is how much the company is going to earn in the next 3, 5, or 10 years. But you have to find the present value of future cash flow. How much that $1 billion 5 years from now worth today? It sounds a bit complicated, but I'll try my best to simplify everything. You can use this metric in the future to value other companies. Of course, no one knows how much any company would earn in the future. It's all predictions. But these predictions are based on multiple factors such as how the company is performing today, where is it investing, what is their strategy, how is the business environment, what are the chances that the company will hit its annual objectives, what is the political climate. There are a lot of analysts who prepare certain type of predictions. Let's say hypothetically there is a company called Amazon and it's expected that it will generate $100,000 every year for the next 3 years. On the other side, interest rates are just 5%. They're expected to stay there for the next 3 years. At that rate, $100,000 next year would worth $95,238. I got that number by dividing the future cash flow, which is $100,000, by 1 plus 0.05% at the power of 1, because the formula is future cash flow divided 1 plus R, which is the rate, at the power of the year. If we apply the same formula in the second and third year, these are the numbers we're going to get. First year, $95,238, second year, $90,702, third year, $86,383. The company's future cash flow isn't $300,000 as it seems at first glance, but $272,323, or the sum of these three numbers. I told you, it's not as complicated as it seems. Here's the interesting part. What happens if interest rates are lower? What happens if the Fed lowers interest rates to 1%, for example? How will that impact the projected cash flow? Let's do the math. First year, instead of $95,238, it is going to be $99,009. When the Fed lowers interest rates, suddenly on paper, these companies are going to make more money, even though nothing absolutely changed for them. Let's do the second year and the third. The second year will be $98,029 and the third $97,059, which makes it a total sum of $294,097, which is higher than the previous $272,000. Remember, the most important thing that investors care about is how much the company is going to earn in the future. That's why whenever the Fed lowers interest rates, stocks become much more attractive, even if they're not going to borrow money. This metric is even more important when it comes to tech stocks, because most tech companies are betting on making huge profits in the future, such as Tesla. It's a great company, but it's barely profitable. But the idea behind it is that sometime in the future, it is going to be super profitable. It is going to make a lot of money. but a dollar today worth more than a dollar tomorrow. So when the Fed lowers interest rates, tech stocks suddenly jump through the roof.